Good day everyone and welcome to today's webinar, New Intraday and Scalping Trading Methods by Chris and I. So we will show you some trading systems that you might want to use with your trading. Have in mind that some of these systems are also aimed for new traders. Some systems are actually created to suit every type of trader. So no matter on which level of trading you are, pay attention to this. You might like it. And as always, if you want to receive the indicators and the templates, feel free to email us and we will send it over to you. Okay, so before we begin, as always, our risk disclaimer explains that CFD and Forex trading are leveraged products and can result in losses that exceed your deposits. This presentation and video is for informational and educational purposes only, and this video is not part of the .co.uk website but the globalnews.com website. I will be first with strategies and systems, and then Chris will continue. So we will actually, I will show you 4 different systems. Everything will be shown on live chart, so there are no PPTs to show you which indicators what, so you need to actually watch the whole presentation and this video in order to try to trade the system, of course. And have in mind that these strategies are different. The first one is called adaptive moving average strategy. It's based on AMA indicator and one more. It's a breakout sort of system where traders could try to exploit breakout of moving average in accordance to one more indicator. Then the next one is called 3MA system. 3MA system, I am the creator of that strategy. It's a very, very simple system based on Heiken Ashi and one more indicator that is very suitable to new traders, and basically it's made for new traders where traders should watch 2 pairs only and then make their trading decisions based on the system. Then 575 system, that is very, very effective scalping system based on customized indicators and some smoothed moving average. I think that you might like that system particularly because both novice traders and advanced traders might use it. I am not the creator of the system, and I received it from a friend who actually trades it, and he received it also from I think from a forum. It was made by a particular group of traders. And finally, equities lower time frame system. It is made for equities indices trading, particularly DAX, and traders who like to trade indexes and, let's say, equities might use the system. My friend, who is very, very fond of trading equities, he uses that same system. It's very simple, based on a couple of moving averages, but have in mind that is solely traded on lower time frames. So you really need to have a strong heart for it, because you know how equities are moving. They can move very, very fast, and the system is definitely suitable for traders who want to be very active during most active market hours. Okay, so yeah, we go with live charts now. No PPTs this time, because I think that when we explain systems, it's much more efficient when we show charts and how it looks like. Okay, for the first system, we use these indicators. Okay, so it's AMA optimum on default setting, moving average 200 simple moving average, okay, on close, and I colored it blue, but you might use other colors. And finally, bears bulls power indicator, okay, that is also custom indicator that is made for this system. The thing is that when you see these pop-up windows appearing, it's for another strategy that I will show you, 575 strategy, that uses also those visual alerts. Okay, so here, what is the thing with this system? This simple moving average defines trend. You can use it on 15, 30 or 1 hour. I saw and I was watching how it behaves on 1 hour. So when the price is below 200 simple moving average, you need to watch this adaptive moving average, okay, and you want to go only with short trades. How do you make those short trades? This is a breakout system. So I advise you to use hourly pivot points. I always suggest with this system to use Admiral Market pivot points, because those pivot points can also show hourly pivot points. Why hourly pivot points? Simply because hourly pivot points change each hour, and for breakout, hourly pivot points can be very important. So go to Admiral Pivot and click hourly pivot points, 1 hour, okay, here. You will have your hourly pivot point displayed. So when price is below SMA, you need to wait for the price to cross up and cross down EMA. So where would you place your trades? Your short trades would be placed here. Okay, here you also need a confirmation for bears, bulls power. Bears power, it needs to be red, okay, like this. So this is your entry. Let me mark it down, okay. So this is your entry. This is your entry. Okay, this is your entry. See, actually this one. And another one. So the rules are simple, okay? The rules are very simple, guys. You need to be, for short trades, price needs to be below SMA 200. It needs to cross from above this adaptive moving average, okay, like this, and bear bulls power should be red, like this. So your short entry here, short entry here, short entry here. See a lot of trading opportunities here. The thing is, you take profits on these hourly pivot points, but very occasionally you might see that hourly pivot points are broken. For example, here they would probably be broken. Then if you decide to leave the trade and use profit stops, as I showed you many times, you actually might wait for another hour for new set of pivot points to be printed out. Also, when you go long, similar rules apply for a long trade. Price needs to be below, then go back up, like here, below, up. So long entry here. Okay, long entry here. Long entry here. See? And you can use, again, you can use hourly pivot points. Stop losses go 5 pips below the entry candle. This is volatility breakout system. I mean, it uses volatility breakouts. And have in mind that definitely this system should be traded only during active market hours. So it's London and New York trading session. I don't know how it performs in Tokyo session. So this system is based on adaptive moving average and bear bulls power. If you want to have it, of course you can send an email to me. Guys, don't type your emails here. You need to send an email to torrentialfx@email.com. I will gmail.com. So torrentialfx@gmail.com. Send your request and I will send it to you. Okay, let's move on to next one. This system, I have created it, and this is an intraday system. So this is not a scalping system, not a breakout system, but rather this is an intraday system. The system is based on different moving averages. So we have 60 simple moving average, 12 exponential moving average, this dotted line. Then we have another set of averages here. It's 60 simple moving averages on a simple moving average on 60-minute time frame. So it's actually showed on 15 minutes. So it's multiple time frame moving average. And the last one is 240 moving average, also applied to 60. What is important here? This moving average is also 60, but it shows 4-hour moving average. We use it exclusively on 15-minute time frame. Let's be clear with this. This system is solely traded on 15-minute time frame. So you will see 4-hour moving average and 1-hour moving average on 15-minute time frame. It's important because when these moving average is aligned, when 4-hour moving average is above 1-hour moving average, it means the trend is to the short side. You can also watch moving average here on this window. But why it's important for us, guys? It's important because you want to go with the trend. This is trend following base system. And here, where would your entry be? It's very straightforward. When you see that price is going above 60 moving average, it means the retracement is underway. And as soon as the price crosses below red and blue moving average, it is your entry. So your first entry is here. Then if you failed, if you didn't make an entry, this could be your next entry. Then again, this could be your entry. Again, this could be your entry, and so on. So the main thing is you rather wait for a bigger retracement. As in this example, when price is crossing, this means that this is a bigger retracement. And finally, this is the confirmation that retracement has been done and you can go with short entries. You can use daily pivot points. If you trade with admirals markets, that I suggest that you do, then again, use admiral pivot points and set the time frame of daily pivot points. So this is 3MA system. It's called 3MA. Very clear rules, guys. When you have different, let's say that we can say pound dollar is in uptrend. See here, a lot of good entries on pound dollar. 4-hour moving average, 1-hour moving average is above 4-hour moving average. And you see here, blue line and red line cross here. First entry, second entry. This could be also your different entries, But I always suggest that the best scenario is when price gets close to 1-hour moving average and then cross back up like this. These are ideal trading scenarios, or like this. See a lot of good examples. But have in mind, guys, that you need to use, again, pivot points for this. And I suggest daily pivot points. So ideal, again, let it not confuse you, because some of you might be new traders. So definitely, if you see this on your chart, you know that trend is to the long side. 4-hour moving average, 1-hour moving average, and you go with long entries. Long entries made when price retraces back to SMA 60 on 15-minute time frame, it's blue, and then it crosses back up like this. Okay, so this is retrace and cross back up. Next one is 575, automated trading system that uses different indicators and has been showing very good results. It's also based on multiple time frame dots that show you the trend on higher time frames. This is a scalping system, 575. It's based on different moving averages, and these are the indicators. P4L clock, this is the clock that shows you which session you are in. So now we are in New York session. You see here at the top of right corner, when you see that these sessions are grayed out, it means that the only active session is the session that is white. Okay, so it's New York session. Then you have smoothed moving average of 8, smoothed moving average of 3. Then you have SMMA crossover signal 21. You can place sound to false or true, whatever your preference is. Fibonacci pivot point, what I can say is, I suggest using Admiral Markets pivot points here, and candle climb to see when the candle closed. This is actually not, you don't need to use, because it's used on 5 minutes. And the motor of the system is multiple moving average that shows different moving average that should align with a trend, like this. Okay, dots, you see. So let's use some of these examples of this system. I think that the system can be very, very interesting for traders who want to be active on the market and who want to trade with a trend. The first thing is you need to watch for alignment of 4 dots. So you have 5 EMA, 89, 55, 34, 13 here. Every single of this EMA actually shows higher time frame, because EMAs are not close to each other. 13, 34, 55, 89. All of them are strong, and they show you the trend on higher time frames. But you need to use it on 5-minute time frame. So here you need to wait for a cross of moving average on the main chart and alignment of the arrows. So here you see these arrows are aligned. I mean dots, not arrows. When you see that dots are aligned, you enter the trade. The thing is, you need to have at least 4 of these dots aligned. Okay, so I always watch for 4 of them. 1, 2, 3, 4. The 5th is not that important. It's okay when the trend is extremely, extremely strong, but the prerequisite is that 4 different dots, 4 different EMAs should be aligned. So here, 13, 35, 55, 89. These should be aligned. This is a red signal. Arrow. This pink crosses green. 4 dots here, and you see this was short entry. Now, long entry filtered here. You see? You see how the long entry has been filtered out? Because you only have 3 yellow dots. You need to have 4 yellow dots in order to go long. Another short entry here. Actually, the short entry happened here. So everything, guys, here needs to be aligned. You cannot randomly place a long or short when arrow appears. So pink above this green moving average, red arrow, then 4 of dots should be aligned. They should be red. Now this is example of long entry. This is valid long entry. Here. Okay, one here. So green arrow, green above pink, and here dotted lines have dotted dots have been aligned. Here, long entry. Another short entry on euro yen happened here. So you see a lot of different scalping opportunities, and as I say, Admiral pivot point is good for this. You can also use hourly pivot points, and from time to time you can also switch to 4-hour pivot points, because then you will have more room to next support or resistance, because 4-hour pivot points are based on 4-hour candle closes. Okay, so you see it's a pretty straightforward system, pretty simple. Ilya is asking, can you send us the indicator of alignment dots? Of course, you can ask for this, just send me an email. And guys, if I don't reply immediately, I will send these systems, well, probably later today or tomorrow. But rest assured that I always email you with indicators, and yesterday I also emailed you with systems you ask for. So if I don't do it just after webinar, in next few hours or tomorrow, I will send it to you. Marco is asking, he sent few emails but I didn't reply. Marco, I saw your last email asking about indicators. I didn't reply. I meant to reply you, but the thing is with the indicator that I use for live trading, it's paid indicator. Both are paid indicators, and we are not allowed to send it. So we can only send indicators that are free, or indicators that Chris and I coded with our coders, because we also have coders that work with us, and we can send you those kind of indicators. But if the indicator is under copyright, we cannot send it. Yeah, I receive, guys, honestly, sometimes I receive more than 100 emails asking for indicators. So if I skip from time to time, if I don't send an answer, just, well, try again. Send me a new email and then I will send it. Keep KP saying, Nenad, you wrote to me yesterday but you never attach them. You see, sometimes it might happen that I write back but I don't attach. So do it now, KP, and I will definitely include it. Okay, so no problem. Can I be your secretary? Yeah, I mean, definitely we are very, very busy, and some things we need to outsource, definitely. So here, guys, I will go because I see that people still are coming in to this webinar, so I will just roll the slides. This webinar is being recorded and it will be uploaded, so you should be able to watch it again. Yeah, the final system before I roll the slides is equities lower time frame system. Finally, guys, this is meant for equities trading. You have very simple system here. 3 moving average system, 7 simple moving average, 20 simple moving average, and 200 simple moving average. This is exclusively for trading equities. And what my friend told me, he trades DAX. The best time for trading DAX is during London Open. You might try to trade it also during US Open, but usually during the first hour of London or New York Open, the system is most effective, because this aligns with a trend on DAX, And you know, guys, DAX is a very, very fast mover, and it can produce huge number of pips if there is momentum in the market. So here the rules are simple. 200 moving average acts as a longer time frame trend. So when when red moving average crosses above blue, okay, and price, and at the rejection of the price, you go long. So your entry could be here, okay, at the very cross, or you can wait for the price to realign like here. So this is your entry. Another entry here. Okay, another entry here. Have in mind that when price drops below 200 moving average, it's usually an instant short, like this. Because then the price should either realign or it will get back on tracks. DAX is different, guys, to currency trading. So you need to treat it differently. Usually, I personally trade only currencies. You can see that on session recaps and live Wednesdays. But my friend who is trading equities, he says that he's scalping with the system. So he has, obviously you need to have a bigger account for this if you want to make some substantial profits, because it's actually used as a volatility system. You exploit volatility in the market and then you scalp on it. Here, your long entry again. See, sometimes drawdowns can be a little bit bigger, but it's 5-minute time frame. Another long entry here. Or there, actually. So very simple system. When price is below 200, it's time to go short. You go short on realignment. Blue needs to be above red. If red is above blue, you don't trade it until it goes above moving average. Here, when you have a short DAX market, when it's very bearish, this is your entry to the short side. This is another realignment entry to the short side. This is another realignment entry on the short side. See here. And another one. So you see, it's pretty much straightforward. Another one here. I mean, you don't need a template. Yeah, guys, for stops, you need to be flexible with stops. Obviously, if you go short, you need to play stops. Here, calculate your risks. It's definitely above swing highs. You can even switch to 15-minute time frame and watch for swings above 15-minute time frame. Or if you go long, then stops are below 5-minute candles. Obviously, if I went long here, I would have placed my stop loss here. But let's say, if I went long here, I would have placed my stop loss below this candle. What my friend is trading with is, I mean, he's a little bit crazy trader. I mean, in a positive way. Because he also trades Hang Seng index and DAX. I don't know, he doesn't trade Dow Jones, and he doesn't, I think only DAX and Hang Seng. He is very fond of those indices. And this is crazy index, guys. This is incredibly volatile index. HSI 50, you have it on Admiral Markets platform. It's most active during Asian session. And definitely, guys, you need to have, I always say, very strong heart for this one. Sometimes the index can move 1,000 pips in a single session. I advise you to try to trade it first on demo account before going live, and then you can go live. So Javier, I'm not sure that this is valid for Dow Jones. What he told me, only DAX and Hang Seng index. Really, guys, he's very fond. He has a knack of trading lower time frames. And you know, guys, I don't trade indices, and this is what I heard from him. He's my very, very good friend, and I mean, he's trading indices full time, so he knows what he's doing. But definitely, as I say, for this you need to have a stronger account, and you can try to make money on that. Okay guys, so as always, send me your requests. I will send you dedicated. Sometimes guys, if I forget, just send it again and I will make sure that you have what you ask for. Thanks guys for your interest. Let's see what Chris has to say, and I wish you a great day ahead. We had a great pound-dollar trade today, and let's continue next week too. Cheers guys, talk to you soon.
Thank you, Nanette. Great stuff from Nanette regarding intraday methods and scalping. I'm going to talk about the same topic, but with a different angle. So let me show my screen first of all. All right, there we go. So I wanted to talk about a top-down approach. You know, definitely, of course, it's good to look at different time frames in general. There's nothing wrong with looking at one time frame, but I mean, Neneth and I both are big fans of looking at multiple time frames, and I think there's a benefit of looking at the larger structure first and then zooming into the best opportunities when looking at higher time frames. So when looking at higher time frames, and you can identify key levels, there's, you know, the price is basically at a decision zone, so there's going to be a higher chance that there will be a strong reaction to that level. Whereas if you're just trading it, perhaps let's say not so much at a key level, it's less clear if there's going to be a reaction or not. The price could go sideways. So I like using higher time frames to dissect the market first of all and then zoom in. Yes, the disadvantage is that there's going to be a bit more time needed to analyze the particular instrument or currency pair, but you do get more insight into the pair. So I use 3 levels for this: high time frame, medium time frame, low time frame. For high time frame, it really depends what type of trader you want to be. Combinations that depend on how long you want to stay in the market. I mean, a long-term trader would use obviously monthly, weekly, daily charts. A swing trader would use daily, 4-hour, 1 hour. An intraday trader could use 4-hour, 1 hour, and 15. A scalper could use daily, 30-minute, and 5-minute, right? So there are various combinations possible. But in general speaking, though, whatever time frame you choose, I look at fractals, fibs, and tops and bottoms for the higher time frame. I use pivot points, moving averages, channels, and Keltner for the medium time frames. And for lower time frames, I'm looking at pivot points, moving averages, and trend lines. So I look at support and resistance, but at different support and resistance levels depending on the time frame of, you know, if it's higher, medium, or lower time frame. Now it depends on which one I use, which time frames I use depend on how I trade, depends on what kind of week we expect. If there's a lot of news, I will try to keep the trade shorter. So I would typically be looking more at intraday trading. Perhaps, you know, not exactly, depends. It doesn't have to be exactly within 24 hours, but I would try to close it within 1 day. Sometimes I try, you know, to keep a trade open between 1 and 3 days. In that case, I could use daily, 4-hour, and 1-hour time frames, right? So I'm more of a trader that keeps positions from a few hours to a couple of days. Not so much a trader that keeps the trade open for 20 to 30 minutes, although it has happened, but not my typical goal, let's say. So what I'm looking for is basically bounce or break scenarios in each of these time frames. So what I'm looking for is a bounce or breakout at the key decision zone. Excuse me. So that depends on the higher time frame. At the higher time frame is the number 1. Am I looking for a bounce there, a break, or maybe perhaps nothing, or perhaps both? So that depends. Basically, I look at 4 things to make that decision when I'm looking for a bounce or break. And they're mentioned on the left side. So divergence, if there's divergence, the trend is running out of steam. The strength of momentum and how corrective is price moving. If there's a lot of momentum, then price will probably break through support or resistance. If price is moving slowly and correctively, it will probably bounce. So it depends. If there's no divergence and there's a lot of momentum, there's a good chance that the break will happen. If there's divergence and price is moving correctively, a bounce is more likely. The third thing is confluence. If there's a lot of confluence of support or resistance, a bounce becomes more likely. And also, I count the number of approaches that price reaches a key level. Is this the first time, or has there recently been a second approach, or a third, or a fourth? If it's the first time, a bounce is more likely. A second time, it's 50-50. A third or fourth approach, a breakout is more likely. Because in that case, price has tested the support or resistance level once or twice already. So a breakout is this time more likely because price is again testing the same level. So it held the first, perhaps the second time, but eventually there is a good chance it will break instead of hold, and that level will probably crack. So that's something I keep in mind too. So these are four things I analyze. So this is a discretionary analysis, but it's pretty simple. Price will either bounce or break, and I just look at these factors to make my best guess, and nothing is lost or gained yet by thinking by myself, I'm looking for a bearish bounce, because that's just one part of the story. And if it doesn't bounce bearishly, what I would be looking for basically is a candlestick confirmation that price is indeed bouncing. So if this seems like a lot to you, perhaps, don't worry, it's just one side of the equation. And nothing is really lost or gained by making this choice. All right? I'm just basically choosing my bias, choosing my analysis based on these four things. What will happen more likely? Bounce or break at support or resistance as price approaches that level. So that's when looking at higher time frames. Price can either bounce or break at that higher time frame level. I'll take a look at an example in just a second. Let's take a look at an example here where price, I will take a look at chart examples in just a second, but let's assume that there's a bearish bounce at resistance on a higher time frame. I'm looking for a bounce, a bearish bounce of resistance. In that case, when I zoom into one time frame lower, I would be looking for a bearish move. Right, because the daily, the higher time frame is setting the tone for the other time frames. So I could be looking for, on a medium time frame, for a bounce or break, depending on what I see. And on a lower time frame, I could be looking again for a bounce or break. Typically, the medium time frame would be a bounce, and the lower time frame would be a kind of a confirmation breakout. So the lower time frame is kind of like a trigger chart. When price pushes through the level, the entry is made. I'll show you in a while, in a second. But basically, on the daily chart, could be a strong daily pin bar, for instance. That's a bearish bounce. On the 4-hour chart, could be a head and shoulders pattern, for instance, visible. And on the hourly chart, there could be a break of the neckline of that head and shoulders pattern. So that's a very good example of using three different time frames and basically seeing a bearish candle on the daily, head and shoulders on the 4-hour, and a break of the trend line on the hourly. To understand if a break or bounce is happening, I look at the candle close of the candle that is at the decision zone. This is basically the key information I'm looking for when price approaches support or resistance. How does it react to that level? All right? So a candle close is very, very important in my opinion on all three time frames, but especially the higher time frame. Basically, I'm measuring the size of the wick in relationship to the size of the candle. So what is the high minus the low? That's the size of the candle. And what is the close? How much wick is on top or at the bottom of the candle? So if I'm looking for a bullish break, I would measure the wick on the top of the candle to see if the bulls can keep control or remain in control. Or I would measure the percentage of the wick at the bottom of the candle if I'm looking for a bearish break. All right. If there is a substantial wick as price approaches support or resistance, that has the opposite. In that case, there's a good chance of a bounce rather than a breakout. Whereas the candle close is near the high or low, then the bears and bulls are in control and there's a good chance of a breakout. So a sturdy candle close indicates breakout opportunity. A big wick indicates bounce opportunity. But what is big? I define it in terms of percentage. If the candle close, if the wick is only 0 to 10% of the entire candle, that's a very strong candle close. Very good. If it's within 10 to 20, it's good. 20 to 30% of the candle wick is okay. Anything more than that, though, is an indecision candle. Too much wick, the breakout is probably not going to be good or will not happen. But I'm not enthusiastic yet about a reversal, about a bounce. But if the wick is 67% or more, that indicates weakness, and then there's a good chance of a bounce. So that candle indicates a lot of info about how price will react to that confluence, that key level, that decision zone with support or resistance. When I look at that's basically how I rate candles in relationship to support or resistance. How I actually enter the chart when I look for bounce or breaks depends on market structure. I could be looking at candlestick patterns on lower time frames. I could be looking for fibs, retracements, or break of trend lines, for instance, breakouts. All right. So I'm going to show you some examples right now. Alrighty, let me refresh this template so we take off those levels. So let's take a look at, for instance, hourly chart, 15 or 4 hour. Let's take a look at daily, hourly, and 5 minute. All right, on the euro dollar, for instance. Doesn't really matter, but so when looking at support or resistance, I look at tops and bottoms on the higher time frame fractals and fibs. So in this case, a fib could be from here to here, for instance, and you can see that the next resistance level could be the 61.8 at 109.30, for instance. I also add fractals typically, and you can see why very quickly. Because as price that has not pushed through a fractal is unbroken support or resistance. So this level here has not been broken. That is resistance. Let's start with support. This fractal has not been broken. So that is support. This fractal has not been broken. That's still valid support, just as this one, right? Don't have to go more than that because, just looking at the most recent price history is enough. 130 candles, 180 candles, anything like that, anything between 100 and 200 candles is enough of market history to look at support or resistance. So these are the support levels where you can see fractals. The other fractals, here, here, and here, those levels have already been broken. So those don't count as support because price has already broken through it. Look, here you can see price has broken through those support levels, so it's not relevant anymore. Broken support does not count. We're looking at support that has not been broken and therefore is still relevant. This one, you might wonder, how about this fractal? That fractal does not count because it is not a fractal as yet. It is not a closed fractal at this moment. All right? Folks, my cat is does not like my story. Give me 30 seconds for me to bring the cat to another room. 1 second. All right, sorry about that, folks. That cat was a bit annoyed. She wanted to play, I guess, and this was not the right time. So resistance, these fractals or resistance have not been broken yet, as you can see. So those are all valid resistance levels. All right, so those are key levels to keep an eye on as well. So just like this used to be a key level, right, but not anymore because it has been broken. Okay, so there are a lot of ways of adding key levels on a higher time frame. Weekly pivot points are great too, for instance. So keeping an eye on the R1, R2, R3, plus these tops and bottoms and fractals and fibs. We can put this fib back on, as you can see. So what I'm looking for is price to reach one of these key levels. So if it's somewhere, at a zone where it's not close to such a significant level, it's less interesting to trade. Of course, it's possible to trade a a trading system that is very rules-based, only looks at one time frame. Definitely has its advantage because there are more signals, most likely, and you can trade it more intensively. But this is another kind of approach that you look at the structure of the market first and then identify which pairs could be more interesting. So instead of focusing maybe on one time frame and one pair very intensively, you can look at the entire market and cherry pick the pairs with the most expectation, with the most potential movement, but also where price has reached a key resistance level. So price has reached the 108 level. That was resistance. It could break or bounce. Let's talk a bit about what seems more likely at this spot, right? We already had one approach here, as you can see, of this resistance zone. Let me open my drawing tool for a second. Excuse me. All right, so, and I'll show you how to count those approaches right now. So here, you can see price approached the resistance the first time. So when it approaches the first time, the rule of thumb I use is that a bounce is more likely. All right, so in this case, a bearish bounce is something I would keep an eye on in this zone. Okay, I would not be looking so much for a bullish breakout. That's also BB by coincidence, but a bearish bounce is more likely at this spot. So on this daily chart, as price approaches this key level, I would then keep that in mind that I'm expecting a turnaround when I'm zooming in to the hourly and then the 5-minute chart. All right, but that's something we'll get into in just a second. This is the second approach. The second is more like a coin toss. It both could be possible. It's 50-50. That's why earlier this week I was saying in my webinars that I think a bullish break or a bearish bounce are both possible. I'll keep an eye on both of those things. In fact, if price were to move down again like this and later on approach it one more time, then the tables turn and a bullish breakout becomes more likely. So this is kind of giving me my directional sense, okay? Now, this is looking at support or resistance only. You could, of course, keep an eye on the trend as well, but that's very, very important, I'm not saying. But this method is more focusing on support or resistance and not on the main focus, the core point is support or resistance, analyzing the strength of support or resistance, waiting for price to get to support or resistance, counting how many times price has reached there. So let me show that one slide again. I'm not saying that trend and patterns are not important, but this method relies more on support or resistance. So one thing is number of approaches, the confluence of that level. How is price approaching that level, basically? All right, so you have how is price approaching that level, how strong is that support or resistance level, and how many times has it approached it. So if there is slow movement and divergence, and there's a lot of confluence of resistance, and it's the first time it's getting there or the second, a bounce is more likely. All right, that's it. If there's a lot of momentum and there's less confluence, and it's the third time price is approaching it, a breakout is important. It's more likely, sorry. So making this kind of estimate is, in some cases, not as easy, and that's why sometimes I am open to looking at both bounce and break. But then I would look at the candlesticks for more information about that. So on Tuesday, there was a good daily candle. So I was saying look for a retracement and a bounce for a break of the high. And that's what happened. We did have a retracement and we did have a break of the high. Then I said on Wednesday, look out for this daily candle because if it's again closed near the high, there could be an actual breakout and a follow through above 108.30. That, however, did not happen. The candle closed bearish, indicating no strength and weakness and a higher chance of a bounce when you're looking at that candle. So this candle, this one indicated breakout or continuation, which actually happened, right? This one screamed, watch out, not looking good for continuation. So point is to wait for price to get into a key decision zone, then trade it because a reaction at that zone is more interesting to trade rather than, let's say, taking taking more trades in an area where prices could go either way. It's kind of in the middle of a zone, in the middle of a correction, in the middle of a consolidation. Anywhere where it's kind of in the middle and it's just oscillating back and forth is, yeah, it's just not in a decisive territory. When price gets into a zone where it really has to show its true color, is it really going to make a retracement here or a breakout? Whatever it does, typically it's going to be a substantial move. So that's why trading those zones are interesting. So on hourly chart, for instance, when I'm looking for a bullish breakout or a bearish bounce, that depends. On Wednesday, I was looking for a bullish continuation, right? So on the lower time frame, I could look for a retracement, for instance. It's clear that Tuesday had a strong daily candle. So Wednesday, as I said in the live webinar, I'm looking for, on Tuesday, I was saying already, if it closes bullish, I'm looking for a continuation. So let's take a look at that. That was here, right? So what do you do on the medium time frame? Let's take a look at the PowerPoint again. And here too, I'm looking for support and resistance yet again. So it's a method really focused on support and resistance, but on different time frames. So I was looking for a bullish breakout in this example. So I'm looking for a bullish bounce or break again on the lower time frame, all right? So the methods I use for that personally on this time frame, the medium time frame, is here. Pivot points, moving averages, channels, and Keltner, and fibs too, by the way. So let's take a look at that. Pivot points, not useful. Keltner, yes, here's the Keltner bottom. Fibs, we can put a fib from here to here. We can see that there's momentum, as you can see right here. All right, so we can keep an eye on fibs. As I said in the live webinar, anywhere around the 2338.2 and the 50 fib are likely candidates. And well, more moving averages, right? Those are typical tools I use. Alrighty, we don't have a moving average here. So moving averages I use 144, 34, 121. So there we go. You see that this was a retracement below the 34, going back to the 34. So anytime when price has, for instance, here a wick like this, for instance, that's more than 2/3, so that's a bounce likelihood, or here a pretty strong bullish candle. Those are basically bullish bounces after retracement. So once again, I'm looking for a bullish breakout on the higher time frame. Bullish breakout. On the hourly chart, I'm looking for a bullish bounce. And on a 5-minute chart, after, for instance, this candle closes with this wick, I can look for the entry. So on a 5-minute chart, I could zoom in, or 50-minute chart, for instance. Excuse me. Let me put there a line quickly. not to get lost. There we go. So the 1 hour wick would have been closed here at this spot. All right, so 5-minute entry. This is a trigger chart. This is not a chart that I have to get very fancy with, right? Because it is whether it's a 5, 15, 30, 1 hour chart, 4 hour chart, daily chart, it doesn't matter. It is a trigger entry chart. So it's all about, it's the medium and higher time frame charts that really matter in the directional purpose. All right. This is all just finding an entry, and that's it. For that purpose, I use different techniques and concepts, such as 3 bullish candles in a row, decent size candles, candlestick patterns, wave patterns, fib patterns, time patterns, and trendline break and fractal breaks, or sometimes a combination of these. So when we go back to this chart, there are more than one options when looking at this chart. So this is the moment when the hourly chart gave us the trigger, that gave us the confirmation to look at this chart. So 3 candles in a row could have been an option right here, as you can see. Typically, I like to take the first 3 candles, which would probably be here. So I don't think that one really qualifies. But for instance, putting a fib from here to here and looking for a bounce at an entry at the 38.2 fib, for instance, 50, 61.8, only the 38.2 got hit, or moving that fib up to the next fractal, and you can see in that case the 50 fib got hit. So 50 fib entry at 107.82, stop loss just below that bottom, because that is basically trading the bounce, basically trading the bounce on the hourly chart, and this is the trigger chart. So there are different ways of trading it. There could be a bounce at the fib. It could be 5 to 6 candles not breaking the retracement. So that's, for instance, here, 1, 2, 3, 4, 5, 6th candle, not breaking this low. So this could have been an entry candle too, for instance. Let's see. What else? Candlestick patterns. Here, this was engulfing twins. This is not a good example because it happened before our red line. But, okay, for instance, here, engulfing twins. Now, 5-minute chart, I'm not sure if I'm more used to, for an hourly chart, using candlestick patterns is fine. 5-minute chart, maybe have to be a bit more cautious with that, right? So it also depends what time frames one looks at. But it is an option, especially on an hourly chart. So what else? We got to look at fibs. We looked at engulfing twins, 5 to 6 candles. Yeah, trend lines, trend line breaks. We don't have really a trend line here, but I guess one could do this, like this, connecting the fractals. So here too, this candle breaking above that trend line, also breaking above the fractal. So that is a breakout basically, right? We got a push, pullback, breakout, and trading basically the continuation breakout by trading the break above the trend line, by trading the break above the fractal. And the trend line break, same thing basically for looking for breaks. Sorry. Okay, this is a bit tricky because it's a 5-minute chart, but you can see it still works fine. Look at the breakout itself here, this candle. So the idea, the concept behind using candle closes and wicks for understanding if there's a breakout or bounce is definitely something that is useful on higher time frames and medium time frames, like daily, weekly even, 4-hour, 1 hour. If you get into lower time frames, this is a bit more, well, because the candles are small, they're less significant, less important. But still, look at this example. It still shows candle, look at that close at the high and indicating a decent breakout indeed, right? So a candle like this helps with identifying a breakout. In this case, I'm looking for On the daily chart, once again, a bullish breakout. On the hourly chart, I was looking for a bullish bounce. And on a 5-minute chart, you can see I was looking for a breakout. As part of this, as part of the bounce, as part of a setup, which I'm expecting a larger breakout to happen. So you see the advantage of trading it in the decision zone is that there's a good chance that price is going to move substantially. So the chances of price going sideways, sitting idle, doing nothing, going sideways is smaller if the trade is if the currency is at an interesting spot, if the instrument is at a spot where there's really a decision zone and there's going to be some reaction to that level, most likely. So by identifying those levels in a higher time frame and then working down all the way even potentially to a 5-minute chart, right, allows me to take an intraday or scalping trade all the way on a lower time frame, but based on some higher level development that's going on. All right? So that's basically what I wanted to share with you today. That's the main kind of idea, is that when trading scalps, when trading intraday, sure, you can take a system and try to trade 5 to 10 times or 2 to 10 times that system, waiting for signals to occur. Just looking at that time frame, it feels easier, right? But don't underestimate this logic and the power of this by doing a bit more investigative work, doing a bit more effort there, perhaps than just looking at one time frame. But when the price gets into that zone, you kind of get rewarded as well for that extra effort by having a better trade, most likely, or trading it at a better spot and time. You see what I mean? Does that make sense? So when people think about scalping, when people think about intraday trading, typically the first thing that comes into their mind is, machine gun style trading, right? 50 entries, boom, right? I know that's a bit a lot, but okay, you get my point, right? Bang, one entry after another, right? But it doesn't have to be. You can be a sniper and snipe at, sorry for all these military terms, but and find the right moment for that scalp that has a better shot. You see what I mean? Does that make sense? All right, so I wanted to give you a blueprint of the steps that that by using support or resistance, more on support or resistance at different stages, rather than mixing maybe too many things like trend and pattern, which I also still use to identify which pairs but you're getting into a bigger analysis already. If you just focus on support or resistance, everything does again go a bit quicker, let's say, and it has some good setups like this. All right, so you got to use logical trade management stuff for that. I mean, using this bottom, of course, makes sense. That's the low of the hourly candle. And targets, well, it could be basically fibs. It could be, that's something I use a mixture of round levels, tops and bottoms, levels of highs and lows of higher time frames. So I mean, in this case, if we take the breakout candle here and put the stop loss below this low, it's about an 18 pip stop loss. So let's take a look at the hourly chart to see the structure of that market. So if we're aiming for the previous fractal up at 108.17, right, then let me go back to the 5-minute chart then. The target is about 25 pips. So 25 pips, 18 pip stop loss. That is almost 1.5 to 1 reward to risk. Nothing wrong with that for such a low time frame 5-minute chart. It's fine. All right. On these time frames, you're not going to get spaces that are typically 10 to 1 because those typically means if you're aiming for a trade that has such a high reward to risk, you're hoping that some kind of support or resistance level would get broken. And that's something that could be done too. If you're waiting for a daily breakout, right, then you could, it's a very decent approach to aim part of the trade at the fractals, but aim the other part at a higher level. Because don't forget, on the daily chart, we are looking for a breakout. So it could be split in that way. All right. Today, yesterday we had a bearish candle. So today on the hourly chart, we'll be looking for the opposite. Let's see if I can get rid of this fib. All right, there we go. So what could have been an interesting zone is, of course, here you got a retracement. So we could expect a follow-through retracement, right? So what could give me the trigger? What could give me the confidence to say, okay, price, is going to continue lower at this spot, all right? So let's take this one away. Once again, I'm looking for a bearish bounce today because yesterday, although you cannot see it, one second, let me quickly adjust it. No, sorry. All right, so let's go to that daily chart. So look at this daily candle, for instance. That was the indication that the bearish bounce, that the breakout is not likely to happen. Bearish bounce, it's more likely. So that's the direction I'm looking for. With that direction in mind, I could look at the hourly chart and look for signals at what point basically a breakout or bounce to the downside is most likely. So this is all Asian session. So let's say we wake up on the London just before London open and you see that there are a couple of bullish candles. We got downside and there's a bit of a bounce. So when is this bounce going to end? So we can put a fib from here to here, for instance, to look for key levels. We can see that there is a Keltner. So any 61.8 fib, for instance, would be interesting. 78.6 fib at R1. So we're looking for candlesticks at these fibs for a turn. This candle is bullish, but has some wick. What kind of wick? Let's count. The difference between the high and the low is only 15 pips. The close is 5 pips off. That's 33% wick. That's right on the border, but not enough to be an indecision candle. So I would not consider this candle to be a bounce candle. But the next one certainly does indicate that the momentum is down. So, that is around 9 o'clock. Let me zoom in. That means I can zoom into the 5-minute chart and I can look for a bounce or break into the downside continuation, right? So 10 o'clock is here. That's where we had the close of the hourly bearish candle. So things to trade could be a trendline break, for instance, like this. We're about to get that, as you can see. So more or less a break below this low indicates a breakout of that trend line as well. All of the other things that I already said, a fib retracement is valid here, a breakout of the trend line, fractal. It depends what the structure is at that point. I have multiple ways I want to tackle an entry on the 5-minute chart because it depends what's in front of me. At this moment, we have price trying to break, so I could put a fib from here to here, and if it retraces, I can look for a bounce, right? But it didn't happen. I could have that fib on the chart at that time, but it didn't happen. But I could also say if it breaks to this low, I take the order, right? I take the entry, either right away or I wait for a candle close to indicate how strong that candle break is, for instance, right? So in this case, it's with a 5-minute chart, I would be less precise with the 30% rule. I think more than 50% would be okay. This one qualifies and is a decent, this is okay breakout candle, and you got the push lower. All right, so that is an example of a breakout. So basically, bullish bounce on the daily chart, looking for a bullish break bounce basically on the hourly chart, and looking for a bearish breakout, on the 5-minute chart. Right? So entry here, for instance, 107.89. Stop loss preferably above a fractal or two, 5-minute chart, maybe even two fractals, 108.01, 108.02, 3. So about, in this case, let's say 14 pips. And the target, for instance, if we had a fib on here on the hourly chart, 272 target, 107.70, 107.75 could be okay. So it's about 14 pips to 14 pips. It's a 5-minute chart, right? So, you know, it's not going to be a ton if you want to get a quick exit and not basically get stuck in this movement. It's okay to aim for more, don't get me wrong, but trade might take a lot longer, of course, to materialize. All right, folks. Oh, wow, the time flew. It's already way later, actually. So thanks for hanging in there so long with us, the extra time here. And if you have any questions, feel free to write me an email or just let me know now still. You know, we're going to be trying to help you out, of course, with any of your questions that you might bump into. There you go. That's the link I wanted. Got several links open. Pulled up the wrong one there. This is Admiral Market, so you can check out education, webinars, seminars, articles. You can also check out analytics with fundamental technical wave analysis, trader blog, calendar, market heat map, sentiment, etc. A lot of good stuff there on a daily basis. I'm going to shut down the webinar very soon. I just want to ask you one question. Did the sequence of events make sense to you? It was, for me, I wanted to get, you know, is there anything that was unclear of this part that I explained to you? Was there anything that you think that you could struggle with? So I have an idea what I can maybe explain better in next week's webinar, because if you're interested in this, in this style or method, we're going to discuss it again next week in intraday trading strategies and indicators and live intraday breakout and bounce trading next week twice, Tuesday and Wednesday. Are there any particular parts that you think are more difficult and you would like extra explanation? Or did everything, what I showed, did all of it make sense? So I need preferably some interaction from you on this, just to get an idea about what you know, parts might need a refresher for next week. Okay, so we got one comment, 2 comments, great. Just to get some feedback about next week, if you don't mind, so I know maybe what to give a bit more time to, because this is going to be the last 2 sessions on this topic. There were like a series of 3 webinars, 3 weeks, I should say. Next week is the last one. All right, so got a couple of all clear and makes sense, and one person, Ellie, saying it's clear to me finally. Great. Yeah, I can imagine it might take maybe a few sessions kind of to put the puzzle together. This is also maybe a better way of presenting it than I had in the live session, so that helps maybe. KP is saying takes time to take it all in, maybe go a bit slower. We can do that. We can take it step by step. And of course, it is discretionary how one reads the likelihood of a bounce or break on the higher time frame. So, you know, that's kind of part of the experience, that is part of it. But we'll dive into, you know, things, all those steps, but take it a bit slower. No problem. EMA values that can be used. I use personally 144 EMA is my favorite for the trend, 21 and 34 for momentum. and 8 EMA for, let's say, current price action in a way. Okay? But I personally think that all EMAs are perfectly fine if used properly, if used not for crossovers, blind crossover entries, right? But if used for trend purposes, for understanding where retracements could go, and momentum, stuff like that. So if you're interested in more examples, more live examples in the market, Tuesday, Wednesday, Nenad has his live trading session on Wednesday too, and his recap on Monday, of course. And next week we'll be back. We'll take a look at trading and news events. Same time, same place. Wish you all great trading, folks. Talk to you soon. Cheers.